Hello. I would like to thank you for viewing this meeting on multifamily investing terms you need to know. In this video, we're going to review terms for multifamily investing, such as net operating income, pro forma versus actuals, and emerging markets. Enjoy the video. Our first term for tonight is going to be forced appreciation. Now, forced appreciation is a way to increase the value of the property without it being controlled by market forces. With single-family residences, the value of the property will always be comparable to the surrounding properties. So no matter how much improvements that you do to this single-family home, you can't improve the value. Like, you can go ahead and add a swimming pool, you can set up the best man cave or the best she shed that possible, but the property will still only be valued within the range of the surrounding properties. However, with multifamily, if you raise the rent or you raise the occupancy, then you immediately raise the value of the property. For instance, let's say you raise the rent $10 on a 50-unit apartment building and you have increased your net worth by $120,000. In the upcoming meetings, we'll end up looking at the details of how that worked. Tonight, we just want to expose you to various terms so you can get the idea of why and how to invest in multifamily properties. One way of sourcing deals is the offering memorandum. The purpose of the offering memorandum is to provide investors with a business plan as an overview of the investment to use as part of their underwriting. A few of the items that you would find on the offering memorandum are photos and description of the property, the market overview, the sources of funds, and the cash flow projections. You have to be cautious going by the numbers on the offering memorandum though, because the broker is attempting to sell the property. So sometimes the projections that they use can be a little aggressive. This is what you would call a pro forma. However, when purchasing, you want to go by the actuals. Pro forma versus actuals. A pro forma is an estimate of the income that a property should be able to bring in. However, if you purchase a property based on pro forma, you're going to be overpaying. When you purchase multifamily property, you have to go by the numbers and buy it for what it's actually worth. The actuals are reflected in reports like the rent roll, where you can find out how many units are rented and by whom and what they're paying for it. You also want to review the T12, where you find the annual income and expenses. We'll go more into this a little later. However, these are some things that you want to know and that you want to base your purchase offer on, all right? You will need to source this information in order to perform your underwriting. Now, underwriting is the most important part of the process of investing. Underwriting is the process where you analyze the property by reviewing the financial information of the business. A few things that you'll want to include in your underwriting is information from the demographics, the rent roll, and the T12. Now, why is underwriting necessary, you might ask? It's because everything has to be backed up by numbers. Through your underwriting, you'll be able to find out if the property will be able to provide you and your investors the returns that you anticipate. You want to understand what the market that you're about to invest in is doing. For example, are rents rising or are they falling? Also, population growth. Are people moving into the area or are they starting to leave? You'll want to compare the apartment's past numbers to what they're doing currently to what your future projections are. And that's all based on your numbers. Cedric, how would you classify buildings to invest in?
All right, William. So building classifications, they are A, B, or C class properties. A class properties are pretty much your newer construction properties. They're in the best locations and they're going to command the higher rents. Number one, because of the amenities that most of them have. Most of them will have that new tech package, the stainless steel appliances. You're going to also probably have either quartz or granite countertops. And some of the buildings or properties, you may even have a doorman. So those are your class A properties. Your class B properties, they're going to be slightly older. And it really and truly depends on who you're talking to in terms of the age of that property. So a B class property is somewhere around the late 80s, built around the late 80s to about the early 2000s. And again, it depends on, who you're talking to, saying what time frame of them, but normally it's somewhere around there. And your C class properties, those are your older properties. They're going to command a lower rent, but also inside of that, you're going to have your working class resident. Okay, you're going to have your working class residents. Where in your B class, you're going to have a mixture of the higher paying working class tenant, and you may also get some white collar workers in that B class. And of course, A class, you're going to have professionals, higher earning individuals in those particular properties.
Mhm.
So the cap rate is a profitability metric. It is used to determine the return on investment of a property. So as you see here on your screen, as the cap rate goes up, your return on investment as well goes up. However, your risk goes up. So when you're looking at a cap rate, it's one of the tools that's going to help you to value your property. Cap rate is say 10 to 12%. That means that 9 times out of 10 that you're in an area that's maybe a harder to manage area, or it could be that the property itself is poorly managed, and also that the occupancy may be low. But one of the beauty parts of this, and if you can stomach the risk, is that your entry price is going to be low. So the sell price is definitely going to come in lower. So now, William, would you take it from there?
Yes. Now, another thing that can affect your investment are emerging markets. Now, what an emerging market is basically a market that's up and coming. When you're underwriting a deal, you want to look into certain key metrics, let's say such as job growth and also demographics, meaning who lives in the area. Are there professionals where you may be able to charge a premium, as Cedric was saying, in like a Class A property? Or are they blue collar workers that may need a subsidy? Certain tourist attractions may be nearby. The workers inside that tourist industry, they need places to live. Having tourist attractions may also be great if you're planning to start an Airbnb. Cedric, how would you compare apartment buildings that's in the same area?
Awesome. There are two ways that you can do that. You're going to either do it price per unit or price per square foot. Okay. So you may ask yourself, like, well, how am I going to know what the price per unit or price per square foot is in a market? You're going to call your broker. Hey, Mr. or Mrs. Broker, what are like size properties in this market going for? What have you seen? So here on your screen, you see 50,000. This is just a way to kind of gauge your offering price when you're going to submit your LOI. Okay, so it may be 50. They may say, okay, it's running somewhere around $50, $55. So you know that depending on the market, depending on how things are in that market, if it's a red hot market, you're gonna know that if they gave you around a 55 per unit cost, then you need to come in kind of strong if it's a red hot market. Now, because you may or may not get a second chance when you're putting in that offer. Some LOIs have round 1 and round 2, but at the same time, you just never know. Now, if you will, William, can you tell them some of the tools that they're going to need for submitting that LOI?
Yes. One of the tools that you're going to want to look into is your trailing 12-month report. That's referred to as the T12 report. The T12 is basically the profit and loss statement recorded over a 12-month period. The T12 shows gross potential income for the property that can come from rents. It will also show other sources of income like laundry services, income from monthly parking fees, pet fees. It could be billing back for utilities. It will also show expenses such as taxes, insurance, managing fees, contracting services, utilities, etc. When you're reviewing the T12 data, look for any large variations in the numbers from month to month. For instance, if you see that there was a spike in the water bill in January, you may want to ask the owner about it. And they may say, oh yes, I remember that pipe froze and it burst open. We ended up having to replace it. Now you know there may be something that you have to plan for next winter in order to prevent it from happening again. Next, we'll take a look at the rent roll. With the rent roll, it will list which units are occupied and which ones are vacant. If they're occupied, it will state who the tenant is, when did the lease start, and when will it end, and whether there are any pet fees or what the late fees will be charged and how much the deposit that they made. Now, the rent roll will also let you know the floor plan because each floor plan would have a different rent being paid. When you look over the rent roll, one thing you want to take notice of is when the lease ends, because if you plan on repositioning it to achieve market rents, then you'll have to know when it ends so that way you know when you can raise them. When you purchase the property, you have to honor the current lease until it ends, and then you can increase your rent. Cedric, what type of leases are there?
There are 3 types of leases. First off, you have your full service lease. Okay, full service lease, that is, you're going to pay one fee and that's going to take care of everything. That's going to take care of your utilities, any concierge fees that may be at that property, one flat fee, and that's it. You're done. The triple net lease, you're not going to see too many of these in commercial multifamily. However, there are some here and there. You may see that type of lease when you definitely see this in commercial retail spaces. Okay, you'll see that where I may have a building and you may want to set up an ice cream shop. So you lease the building from me and you come in and you get it constructed just the way you want to have it set up. That is your triple net lease. The modified gross lease, that's primarily what you will see in most apartment buildings now, where you may have the tenant paying utilities, may have them paying gas and electric, and you being the landlord or the owner of the property, you may have to pay the water. That is one of the biggest things that you're going to see as being a lease when you're owning these commercial multifamily properties. So next, I'll talk to you guys about the NOI. This is another calculation that will help you to figure out what the value of the property is. So the NOI is a calculation used to analyze the profitability of income generating real estate investments. So let me break it down just a little bit more. As you see on your screen, your rent was $200,000, expenses was $100,000. So your net income, your net operating income is $100,000. So look at this, as your NOI goes up, your cash flow goes up, and so does your value. And now you guys may remember me speaking a little bit earlier with regard to cap rate. The NOI and the cap rate, they both help you. They kind of work together or inverse, where you can have if you have your cap rate, if you know your cap rate and you know your NOI, it will tell you what the value of that property is. Okay. Vice versa, if you know the value of the property, right? You know the value, you know the cap rate. It will help you to figure out what your net operating income will be. Right here, the DSCR, the debt service coverage ratio. The debt service coverage ratio, it's basically the amount of cash flow left over after paying your mortgage. So your mortgage payment, that's your debt. That's your annual debt that you're going to pay, right? So you have your NOI that I just talked about. And what is your mortgage payment? So for this example, it's $80,000. That's what you're going to pay throughout the year. You're going to pay $80,000. Your NOI is 100,000. So you have 1.25, which means that the amount of income that you made, it covers your debt 1.25 times. One of the reasons I have that example in there is because when you go to get a mortgage, a commercial multifamily mortgage, they want to make sure when they're looking at your analysis, your underwriting, that you cover 1.25 times your debt payment. That is one of the main things that they are looking for, meaning the banks, the lending institution. So you definitely have to make sure during your underwriting that, and if it doesn't cover that, then there's really and truly no reason for you to even submit an LOI, because no banks are going to allow that to, and just like William mentioned, remember he mentioned Proforma and actuals. The bank is really they're not going off of Proforma. They're going to look at the actuals. And so it definitely has to be 1.25 times. So the next thing I want to talk to you guys about is the cash on cash return. So the cash on cash return is basically a rate of return often used in real estate transactions that calculates the cash income earned on the cash invested. Okay. Right here, it says, I love this. It is not the amount of, it's not about how much money goes into a property, but about how fast the money comes out. So if you see right here in this example, we're making $12,500 a year. Okay. But your down payment to get into that property was $50,000. So it's going to take you 4 years to get your money back. And based off of this calculation, it's 25%. So this is one thing that I really and truly want you guys to understand about the cash on cash return. A lot of people are looking at that figure because you put your money in, you want to know how long it's going to take to get your money back. William.
Hello. I would like to thank you for viewing this meeting on multifamily investing terms you need to know. In this video, we're going to review terms for multifamily investing, such as not. That's where this comes into play. Because there will be things that said shouldn't be said. Take 2. Hello. I would like to thank you for viewing this meeting on multifamily investing terms you need to know. In this video, we're going to record. Okay. This will be take 3, because I don't know how to read.